Good evening, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, the S&P and the Qs getting a little bit of lift. After 4 straight days of decline on each of those respective indexes, we are now moving a little bit higher. And most of that heavy lifting was actually done by some of our big tech names. Overall, the market was decently broad today. And of course, that was off the back very early this morning of a very favorable CPI report, which showed that the inflation headline numbers came in at 2.7%. That's not the right chart. This is the right chart. 2.7% year over year. However, there was a few holes in the data, but we will be covering that on the channel as well. Now, I'm reporting this video very late tonight because I wanted to wait for the Bank of Japan catalyst, which was the last catalyst for this week. I won't be making a video tomorrow because I'll be gone for my birthday over the course of the weekend. So I figured I should wait for that last volatility catalyst of the week and see whether or not the rumors of the Bank of Japan increasing interest rates this term would be true. And as a matter of fact, they were true. There was about an 82% probability coming into tonight, so it was not that much of a sure thing. A lot of people said that it was mostly priced in, which it probably was at this point in time, but the commentary from the Bank of Japan, which will be happening in about an hour and a half, that will be one to watch. But as of right now, I can humbly report that the Bank of Japan has indeed increased interest rates. Here you have it right now. Well, I'm pretty sure you guys can't read Japanese, so sorry about that, but it is right there, 0.75%. But overall, not too bad here, guys. We did get a 0.75% read on the actual chart from the Bank of Japan. This is pulled from their website directly here. So we'll cover a bit of these details a bit later in the video as well. But those are the two biggest things that we had to watch today. And both of them played out pretty nicely. You can see the futures market responding well to that Bank of Japan and interest rate hike right now, only because of the commentary, or rather the brief commentary that was provided over the course of not that page, this page right here that we'll cover in a few short moments. So we got a lot to talk about today, guys. In terms of today's video, we'll be going over a few key things. Number one, the CPI report. Number two, that Bank of Japan interest rate hike. And then a few news pieces that I figured should be interesting for our analysis today. Thereafter, we will go through a full index rundown, check on the rotation from the SPY, the QQQs, and our minor sectors as well. Check on which sectors are performing the best and which ones are still lagging behind. Thereafter, we will do the same thing across our big tech names down here. Big tech had a really good day today. Will it continue? Was at the bottom? We'll get to the bottom of that, no pun intended. So across the board, decent pushes by big tech. So once again, we'll go through this list and derive which of these stocks are possibly good trade opportunities or nice opportunities to add to the long-term portfolio. And at the very end of the video, as we usually do, we'll be going through the biggest gainers and losers of the day, of course, of which there were very many. So we'll cover a few names that were on the downside today, derive if there's any investment opportunities here, and the same thing for some names that pushed up a lot today, and derive whether or not some of them are still in attractive locations that we could possibly make some trades from them. So that being said, guys, let's get into the video. Should be a fairly fun one tonight. So the SPY up 0.76, the Qs up 1.45%. Overall, the heat map was not too bad. Take a look right here. I mean, this market was looking a lot better very early this morning. If you look at the price action today, it was kind of all over the place, right? We had a very nice gap up open into our resistance range, which, let's be honest, is just the last 15, 16 trading days. We broke down below, we back tested it this morning, and we got kind of rejected and kind of just settled down here. It was a good day overall, but it was much better this morning and a lot more broad than when we concluded the day. So we will see if tomorrow the bulls are able to mount above this resistance point into the end of the month of December, whereby we should be getting the Santa Claus rally. That usually comes Boxing Day into the few first days of January. So overall, the rotation was better this morning. It kind of fell off, but big tech doing some heavy lifting today, and we really needed that after big tech has suffered a lot in the past week and a half. Financials not too bad, healthcare not too bad, but still, right? It was better this morning, kind of unraveled throughout the day, but that's fine. Still not too bad in terms of market breadth today and advancing and declining issues. The bottom half of the market as well, not performing too poorly, although defensives weren't there today, nor was real estate, and nor were the energy names either. Taking a look at your one-day relative, you can see that even better to where cyclicals were actually the best performer of the day, followed closely by technology and communication services. Shout out to industrials, utilities, basic materials, and financials as well. To the downside, real estate, defensives, and energy overall. And on your 1 week relative, was it enough to move the needle? Well, not quite just yet. Cyclicals and defensives are your only sectors this entire week that were positive. Even today's big jump in technology was not enough to erase the last 4 days of downside. And you can see technology is still your worst performer on the week overall. That being said, fear and greed index still in a fearful environment as the market momentum remains somewhat soft overall. Your stock price strength, although improving from the lows of November, is still in neutral territory, and your overall breadth indicators are still in a somewhat fearful environment, at least as measured by the McClellan Volume Summation Index, although some of our other breadth indicators are not looking too bad. We cover these almost on a daily basis. If you take a look at the percentage of stocks above their 20-day EMA, it's not too bad, guys, up here at 56%, right? That being said, definitely not the lows of November. So now we're in a nicer location, right? The markets have retraced a little bit. It allows for some expansion to the upside. Percentage of stocks above their 50-day EMA, same thing. Not as bad as this circle down here, which was the end of October into early November. We're currently sitting at about 56% of stocks above their 50-day EMA. So a lot healthier of a market, a lot more broad of a market, even though tech has been the subject of many sell-offs in the recent few days. There is some room for some expansion to the upside because it's been a mostly sentiment-driven sell-off, which is what we've been talking about almost every single day as it's happened over the course of the past month and a half. And percent of stocks above their 200-day EMA sitting at a relatively healthy 59.60, which is indeed a lot better than the late stage of the month of October and early November. You can see here that we're kind of clipping into some of the highs that we saw earlier during the summer. So the market is indeed more broad than the last time it was close to the all-time highs, which overall is a very good thing, all things considered. Now, in terms of our news events that we have to cover today, number one, let's go over this Bank of Japan news because it's fresh off the press. I'm not going to have to close this page, man, because I can't read Japanese. I'm sure some of you can, but not me, unfortunately. I kind of brought it up just for a bit of a, a bit of a joke, but still, moving on further here. Take a look at what was released on the Bank of Japan's website. It is highly likely that the mechanism in which both wages and prices rise moderately will be maintained. So that's why the Bank of Japan is increasing their interest rates to counter the trend of higher inflation. Now, a good thing, though, is that wages are increasing too. And if you know anything about Japan's economy, it's been one of stagnant wages for a very long time. This commentary, though, is what's pushing the market green. Although even they have rising prices, they're getting rising wages as well, which is good for the economy, right? Supposedly to be bad for the Japanese carry trade, but overall good for the Japanese economy. And I do believe that's why the markets are responding fairly well to that. The likelihood of realizing the baseline scenario that CPI inflation will be at a level that is generally consistent with the price stability target of 2% in the second half of the projection period of October 2025 has been rising. So at least it's not runaway inflation. It is moving towards target in line with the expansion of their overall economy. Moving on further, the US economy and the impact of their trade policies on the Japanese economy, they said while uncertainties remain, they have declined. Also, the market responding well to that as well. In terms of wages, it is highly likely that firms will continue to raise wages steadily next year, following the solid wage increases this year overall. The risk of firms' active wage setting behavior being interrupted is quite low. And here you go in prices. The underlying CPI inflation has continued to rise moderately, not aggressively, not out of control. You can see the keyword used here was moderately, with moves to pass on wage increases to selling prices continuing overall. So there you have it, the raise to 0.75 overall, not too bad. Real interest rates are expected to remain significantly negative, and accommodative financial conditions will continue to firmly support economic activity. So not too bad. Obviously, we still have to hear from the comments from the Bank of Japan, similar to how Jerome Powell, after the rate decisions, comes out and kind of gives a bit of a speech, pre-written statement, and then possibly taking a few questions in the mix. But overall, not a very bad release from the Bank of Japan, and the market is indeed enjoying it. And some of your risk assets, such as Bitcoin and Ethereum, also, when that news was released about call it about 30-40 minutes ago at this point in time, not too bad either. So I waited a long time to film this video before that, before the BOJ came out with that rate release, but I figured it could be noteworthy for our analysis. So I kind of held off just because you guys will have kind of all weekend to absorb the content of this video right here. Now, moving on to the US's own respective news, we'll take a look at the headline inflation rate, which was 2.7%, much lower than the expected 3.1%. And even on core right here, you got the 2.6% print instead of the 3% expected. Now, that was good, but there were a few key little holes in the analysis. You know, the Fed warned us about this as well. And then CNBC coming out with an article saying trust these numbers? Economists see a lot of flaws in the delayed CPI report showing downward inflation. Number one was the fact that, well, owner's equivalent rent, which is a good gauge of shelter costs inflation, well, it came in flat. I assume just because the Bureau of Labor Statistics just did not measure that. So that was kind of an outlier in the report. It could be impacting the numbers overall, so keep that in mind. But for the numbers that we did have, well, it wasn't too bad. Food at home only went up 1.9%, which is below the overall rate of inflation. Food away from home still is in a bit of a sticky territory, but that's been the case over the course of the past 3, 4, 5 months at this point in time, 3.7%. You had a slight uptick here in energy prices overall, which should probably be reversed because at this point in time, the prices of oil have done nothing but come down here over the course of the past month, during the month of December, but it depends from where you measure, right? Overall, but you can see here that throughout the month of October, depending from where they measured, it was up a little bit, but still, I wouldn't be too nervous about the uptick in energy prices overall. Moving on a bit further, all items less food and energy overall, which is your core. Well, here you can see several other metrics here to the upside. Now, not too many notable ones overall, but still, you did have some metrics that were kind of above the overall rate of inflation. And here, CNBC, of all the basket of goods, is just presenting you the ones that are overall above the current rate of inflation currently. There are a number of other ones currently bringing them down, so we'll keep track of this on an ongoing basis. But you guys know me, right? If you can't trust this data, maybe you can trust the Truflation measure, which is a measure of 15 plus million products on a daily basis by SKU. And we bring this one up almost every single week just to keep track of it. And you can see the overall rate of inflation across goods and many services, 15 million plus data points to be specific, is only at 2.51%. Once again, reiterating our own thesis that inflation is gone. It's done for. Has it been slightly increasing here from the lows of April into right now because of tariffs? Yes, but is it runaway inflation? No. And we also heard from the Fed's summary of economic projections just last week, and they also believe that into 2026, your target PCE inflation rate should be about 2.4%, and then into 2027, 2.1%. And of course, that is a downward revision for 2026 from the September projection, which put it at about 2.6%. So decent numbers overall from inflation, nothing really to report there either. But the markets did respond well to the headline numbers, even though there was a few missing parts from it, right? So obviously the December inflation report, which will have full data, will probably be more noteworthy for the Fed and maybe even more noteworthy for our analysis. But if you're looking to keep track of the overall prices, you can take a look here at this website right here, Truflation. They do a really good job of compiling 15 plus million different things on a daily basis. Now, moving into the rest of our news cycle today, there's some interesting things. It was a bit of a light day for news, but still some interesting things I thought I should bring up. Number one here, Santa Claus rally. We got to talk about it, right? So this is the 5 last trading days of the year, plus the first 5 days of the new year. It's been positive 19 out of the last 25 years, which is about a 76% hit rate with an average return of about 0.8%. The last 2 readings on this chart were negative. And over 56 years of data, the Santa Claus period has never posted 3 straight negative years. Here you go, right? So the 2023 period, negative. 2024 period, negative. 2025, big question mark, but never in history has been read 3 times in a row. So if we were just take the statistical odds, right, you would assume that right now you probably will get a positive Santa Claus rally. At least it's not setting up too poorly for that. We've already had a lot of the sentiment decline coming in from November and now into early December. A lot of the big news items are behind us, and we have a bit of a catalyst vacuum, guys. There's nothing big to report much until January the 9th and January the 10th, when we get the new jobs reports. Until that time, there's a bit of a data vacuum, right? So unless we get more negative headlines from Oracle or CoreWeave or anything in relation to the credit cycle surrounding the data center build out, you should be okay, and you should not be responding too negatively to anything that comes out of the press, because there is no news events moving until January the 9th. Now, moving a bit further here, YouTube podcast viewing doubles to 700 million hours on TV. Just shows you what a tremendous asset Google actually has in the name of YouTube overall. That's up from about 400 million hours earlier, and YouTube hit 13% of all TV viewing across streaming platforms in November. So it just goes to show you how strong YouTube actually is in this entire game. Those numbers were just released today. So fantastic numbers posted by YouTube once again, which gives us a bit of bullishness, obviously leading into Google's Q1 earnings. Moving on to the next post here, something big that happened after the close today. TikTok says it signed a binding agreement to move its US operations into a new entity, a joint venture backed by Oracle. This news is not new. They were bidding for it anyways. Silver Lake and Abu Dhabi's MGX, with the deal expected to close January 22nd. We've been waiting for this TikTok deal for a very long time, right? It was in the works, it was in the pipeline, but we had no final confirmations. Now it's actually agreeing to move the US operations into a joint venture and possibly sell off the US arm of their business. So each of the three managing investors will hold 45%, or rather, together, they'll hold 45%, 15% each. And the affiliates of current ByteDance investors will retain about 30%. ByteDance itself will retain about just under 20% overall. TikTok says that the US user data will be stored locally on Oracle-run systems, which was the problem that the administrations had been having with this, how that all the data was being reported back to China. Now that will be stored locally on Oracle systems. And the recommendation algorithm will be retained on US data under a majority American board, which is good, obviously, now that we finally have this deal concluded. Moving on a bit further here, OpenAI is reportedly in talks to raise up to $100 billion, a round that could value the company as high as $830 billion if it reaches the full target. You might remember we spoke about this yesterday when Amazon committed $10 billion to invest into OpenAI. They've obviously raised capital from a number of different hyperscalers so far, Amazon just being the most recent one. And as a result, now your total funding round is very close to $830 billion in valuation. There are a few more bidders here, OpenAI possibly leaning on sovereign wealth funds as well as it tries to fund the massive compute needs. The cash burn projected at more than $200 billion through 2030. So we'll keep a very close eye on this story as it develops. Maybe one of the biggest IPOs in 2026 with SpaceX, which you just talked about just a few days ago. And now, last but not least here, this is something I figured I should bring it up from good old Ryan Dietrich, who often appears on CNBC. And we've been talking about the credit default swaps for names like Oracle, names like CoreWeave. And there's been a lot of chatter in the most recent few weeks about, do Oracle and CoreWeave and a lot of other data center builders have the cash to pay for all the debt that they're raising to build these data centers, right? And there's been a lot of impact here on the private credit market, specifically in terms of the credit default swaps running very wild, right? In terms of the bankruptcy odds of these companies trickling higher. But if there's really a big private credit problem, you would probably see it in the bonds first. We've been talking about this a lot, but just to reiterate here, he said this as well today. High yield corporate bonds were barely red on the day and less than 1% from the all-time highs. Obviously, if there was such a big issue and yields were upticking across the board, across all corporate bonds, right? Well, then you'd have a big problem. You'd start to see the corporate bonds sell off. But as you can see from this HYG chart right here, it's been a very stable endeavor so far. So mostly noise, in essence, is the summary of the most recent last few weeks in terms of your data center players overall. We also heard from Sung Cho from Goldman Sachs the other day. I played you a bit of a video excerpt, and he was also saying that the sentiment right now is kind of all over the place and that people don't truly understand that when you look at the numbers, only 10% of the data center build out is actually being funded by true debt, whereas 90% is actually being funded by operating cash flows. So just to kind of put this one to rest once and for all. But we know those news headlines can be very polarizing. So hopefully in the last few days, I was able to make sense of the noise for all of you guys that may have been concerned with the overall AI landscape. And those were your major news headlines for the day. Hopefully you guys enjoyed those. Now, let's jump in to some earnings before we get into more charts. And we're going to cover the only one of the day. I mean, there was a few other ones, but I figured that Nike has the most retail interest. So we'll just be going over Nike today. Nike coming out with earnings after the bell. And, well, sadly, they dropped 10% again. Now, once again, coming back to time machine prices, Nike currently around $58. The same prices that we had, well, during the tariff sell-off and a few other moments in time, namely during the peak of the pandemic sell-off and the true time machine prices, 2016, 2017. What an absolute terrible year for Nike overall. As a matter of fact, this concludes, well, not concludes, because there might be a little bit more, 3 very bad years for Nike overall. But let's go over some of the numbers and explain why indeed this happened. If you can see here, they did beat on EPS this quarter at least by 41%, and they beat on revenue by 1.82%. So why did they fall off so much? Well, it had to do with some unfavorable guidance and some unfavorable tariffs overall, tariff impacts overall. So let's move into some of the numbers here from Nike. Here you have another meme chart by me. Sorry, I know I'm strong with the memes today. Here you go. Here's your Nike swoosh. a perfect representation of the business and its chart. But actually, let's move into the numbers right here. So taking a look at revenues, as we said, they beat by 1.8%. Not too bad overall. Gross profit beat by 2.8%. However, it was still down 6.3% year over year, guys. And this is the impact of tariffs. We'll discuss this a bit more as we move into it. Operating income also down 27% year over year. Although they did beat, right? They're still down by a wide margin year over year. And Wall Street just isn't able to reconcile this big beat on this quarter with the amount of drawdowns that they've had over the course of this year so far, which is why even though you have a nice EPS beat, they're still down year over year, right? So the recovery story on Nike is still fully underway as well. So that being said, taking a look at the article right here, Nike shares fall 10% as China sales plunge. And we'll break down the data, where the sales were coming from, how is North America doing, how are their other markets doing overall. But suffice to say, guys, Nike has had 3 problems so far, and we've discussed these problems ad nauseum over the course of the past 2-3 years at this point. Number 1, wholesaler relationships, which were absolutely destroyed by the previous CEO in his quest for moving the business to more direct-to-consumer sales, both through stores and both through online. In the process, they alienated a lot of the wholesale markets, such as Foot Locker and Dick's Sporting Goods, reducing their shelf space, right? Reducing the visibility of their brand in a lot of common locations that you guys know very well. So the wholesaler relationships needed to be mended, and that the CEO has been working on it so far. And wholesale numbers have been doing good, but it's now come at the detriment of their direct-to-consumer sales. So that one, still a bit of a toss-up. Number 2 problem was Nike sponsorship deals and innovation, right? They kind of lost themselves over the last few years, going more for streetwear and activewear, and not so much doing the big sports sponsorships that the company was renowned for in the past, right? Sponsoring athletes like anywhere from, like Michael Jordan, and then the LeBron James era, and then so many huge athletes, right? In the past 3, 4, 5 years, Nike wasn't really doing much of those anymore. They're kind of focusing on becoming more of a streetwear brand and things like that. It didn't really work out for them. So those sponsorship agreements were very large. Now, the CEO's been doing a very good job since his most recent tenure of the last 2-3 quarters, trying to sign big athletes and rekindle some bullishness into the brand, at the same time investing into innovation, because as I said, they kind of moved into streetwear and they weren't really innovating, and it opened the door for other brands such as Hoka's or On Running overall and stuff like that, or Asics additionally, right, to take over in terms of innovation for actual running shoes, not just streetwear shoes, right? No, actual running shoes. And so Nike's now fighting from behind in terms of the innovation front in comparison to those other newer brands. And now lastly, the last thing that they had to work on, guys, was the China market, right? And the China market, especially also the inventory problem that they had. Those are the 2 last remaining problems overall. So let's discuss all of those problems. Quick little summary, right? Wholesalers. Number 2, inventories. Number 3, China's. And number 4, sponsorship deals. Those are the problems that Nike's been facing and have been the subject of their turnaround story. So let's move into the article, but I figured I should give you guys context, right? Because without context, none of this stuff means anything. The sneaker company is just over a year into the new CEO's turnaround strategy, focused on regaining its growth and market share, clearing out old inventory, of which they still have $8 billion. It's ridiculous, and investing in its wholesale relationships. Fiscal year 26 continues to be a year of taking action to right-size our classics business, return Nike Digital to a premium experience, diversify our product portfolio, deepen our customer connection, strengthen our partner relationships, and realign our teams and leadership. The CEO basically saying, yeah, we're working on it, but it's not quite done just yet. Notice that all of this is still a work in progress. And I say we're in the middle inning of our comeback. We're nowhere near our potential, he added. The CEO said that Nike's improvements in its China market are not happening at the level or pace that we need to drive wider change, though he said the country remains one of the company's most powerful long-term opportunities. Now, this is just because China's market has been relatively weak in the past 2 years. Consumer discretionary spending there is additionally a problem as well. But also, Nike has kind of lost its style. If you go to TikTok and you go to Twitter and things like that, and you look at a lot of the largest Chinese influencers, not so much Nike anymore. But that's not only a Nike problem. That's been happening also in luxury goods. There's been a big return to, national brands for the Chinese consumer overall, whether that's in the Chinese car market, whether it's in the electronics market, and additionally, especially the fashion market, right? The younger demographic of the Chinese market is changing. If you guys don't know about those trends, I highly suggest that you read out upon it, because Nike will never admit that. But when you look further into it, you do notice a change in consumer preferences towards more national brands, away from the Western brands overall. And that's been happening. And you can even ask Starbucks about how their China story is going. And the same thing is happening to Starbucks. A lot of Chinese consumers preferring their own brands, such as Luckin Coffee right now. So that's very noteworthy, guys. When we talk about China, it's not something that you'll hear these executives talk about a lot, but it is going on behind the scenes. And that's why you guys have me, right? Because you always have to keep in mind, right, the social trends behind a lot of these numbers right here. Nike expects fiscal third quarter revenues, here's your guidance, to fall by a low single-digit percentage with modest growth in North America. So still not good enough on the guidance. It also anticipates gross margins will drop another 1.75 to 2.25 percentage points. So after they're already down margins on the year, are they recovering into next quarter? Still no. Gross margins down, and including a 3.15 percentage hit from tariffs. So still not through the whole tariff debacle. Nike has also been feeling the impact of tariff increases. It said that Thursday that the gross margin decreased by 3 percentage points and inventories dropped 3% primarily due to higher tariffs. Moving on further, despite the weakness in some parts of Nike's business, the company highlighted some areas of strength and new initiatives ahead. The CFO said on a call that Nike.com posted its best Black Friday ever this year, partially driven by its Air Jordan Black Cat launch. Nike also plans to launch a new footwear platform in January called Nike Mind, which aims to help athletes prepare for performance and competition, the CEO Elliot Hill said on the call. So there's a few things that they're doing well, but there's still a few things that they're not doing so well here, guys. Let's get into the actual numbers. Revenues overall were up 1%. 1%, but flat on a currency neutral basis. Now, of those revenues, Nike brand revenues were up 12.1 billion. That was only up 1%. Why do they say Nike brand? Well, because they also have the Converse brand, and the Converse brand was terrible. It's still very bad. It's been terrible in the last 3 years. Still no turnaround. Revenues for Converse were only $300 million, down 30%. That's not very good. Of the Nike revenues, wholesale revenues were up 8% to 7.5 billion. That's very good. It shows that their initiatives to rekindle the wholesale partnerships are working, and you get a lot more brand visibility when your shoes are in physical wholesale locations as opposed to forcing people to go online, right? It's all about visibility for Nike. They used to be everywhere, and now their shelf space was reduced over the course of the past few years. They're trying to get that back. However, this wholesale expansion has now come at the detriment of their online presence and even in their own stores. Nike direct revenues, which includes in their own stores and online, were down 8%. So literally an offset here, but you'll notice wholesale revenues are bigger than Nike direct. So they need to focus on those wholesale partnerships, right? Now, so there's a bit of an offset there in terms of percentage, but wholesale revenue, 7.5 billion and Nike direct, 4.6 billion. Gross margin, we talked about it, down 3 percentage points, down to 40.6%, primarily due to higher tariffs in North America. SG&A expenses, selling and administrative, were increasing 1%. The demand creation expense was 1.3 billion, which was up 13%, primarily due to higher brand marketing expenses and higher sports marketing expenses as well. This is where you have the sponsorships as well. They talked about this when the new CEO took the reins about 2-3 quarters ago. He said, listen, we're going to create this new thing called a demand creation expense, and that's them trying to rekindle the brand in the eyes of the consumer through various athletes and through various other channels as well. In terms of inventories for Nike, they were still 7.7 billion, down 3%. Nike's inventories have been stuck at between 7.5 and 8.5 for the past 3 years. You got to get this down, man. It matters a lot when you're holding so much inventory. I will remind you, Nike is a company that, currently this past year generated about 46%, $47 billion in revenues, $7 billion. That's too much. It's just way too much of your revenues overall, right? It's representing about 15% of their overall revenues. That's too much. You should be holding like 3 to 5% in inventories, and most of that should be just in time, managed with the just in time system, right? So 15% is too much. It's way higher than their historical standards, and it's a problem for the company because it's all about fashion trends and styles, right? You hold inventory of past styles too long, people just won't want them anymore. And then you have to liquidate them close to your cost, which once again impacts margins. This has been a problem for Nike's margins for the past 2-3 years. Still a problem for them today. Now we can take a look at some of their revenue breakdowns here by segment. So take a look here, guys. It's not the best, right? North America footwear, right? That was up 9%. Apparel, 7%. Equipment, 12% for a total of 9%. That was okay on a 6-month ended basis. It was up 7%. But keep in mind, right, guys? These are year-over-year comparables. Last year, Nike was an absolute disaster. So they're not the toughest comparables to beat at this current stage. As you can see, slowdown in revenue. And now we're looking for the upswing type of thing, right? So I guess that's okay. But it kind of all falls off a cliff after that. If you take a look here at the Europe, Middle East, and Africa, footwear, 2%, apparel, 5%, and equipment down 1% overall. You remove the impact of currencies and net neutral, that's actually down, which is not the greatest look. And 6 months, still overall down. Footwear, equipment are down. Apparel is a bit of a boost. 0% change, 6 months, minus 1% change on the 3-month period. Greater China, right? Footwear, okay, down 20%. Apparel down 6%, equipment down 24%, and overall totals for the last 3 months down 16%. And in the last 6 months, overall down 13%. Still struggling. And look at APAC and Latin America, right? Asia Pacific and Latin America. Footwear down 7%, right? Apparel 5%, which is okay, but it's not as big as footwear. Equipment down 19%. Total down 4%. And the last, this is this number right here. Excuse me, I should highlight them. And the number overall in the last 6 months down 2%. So global brand divisions here, guys, right? Minus 31% percentage change in the last 3 months. In the last 6 months, minus 32%. So there's the other global brand divisions such as Converse and things like that. Not very good, which leaves you at the total Nike brand, or sorry, this is the other brand divisions. Converse is down there. Total Nike, 1% in the last 6 months. That's in the 3-month basis. 6 months, minus 1%. It's just not good. You know what I mean? So the turnaround story is still in full effect right now. We will see what happens in the near term. But all that being said, are we closer to the bottom than not on Nike? Well, I do truly think so at this point. We've been saying this for the past 2 quarters overall after they keep selling off on earnings. This whole lower 60s area, guys, as I said, it's a few key things at the same time, right? It's time machine prices. It's the tariff lows, it's the pandemic lows, it's 2016 and 2017. But 2016 and 2017, they matter a lot, guys, because if you take a look here, the stock's price is always a reflection of its EPS, right? Where are we on EPS? We're literally not much better than we were back in 2018. So it makes sense that the company is literally trading back to the same EPS that they had back in 2018 and the same share price that they had back in 2018 roughly as well, which is why EPS consistency matters so much. That being said, at $58, is Nike a good buy down here? Well, they're trading at a forward 22 price to earnings. This crush, you would expect Nike to be trading at a forward like 10, right? But no, that's the importance of EPS. When your EPS gets crushed, well, sadly, your price to earnings ratio stays the same. The forward PEG ratio right now at 58 is a 0.89. Not terrible. They're growing EPS really fast for the next few years. But once again, that's because they're coming off of a very low number. They will not grow at EPS 25% forever, right? So you got to take this number with a bit of a grain of salt. There is some possible upside for the recovery of the brand, that's for sure. 1.84 price to sales is probably the best metric that you can have for Nike. This one usually trades around 3 to 4, at least when business is good. So at 1.84, you're not taking a big risk for the business. And at a 3.3% free cash flow yield, you're also not assuming that much risk buying the business down here. If you are buying the business down here, guys, you got to keep in mind, this is a multi-year recovery story. And the new CEO has talked about this many times. He literally just said it right now. They're in the middle inning of the recovery story. The numbers still aren't there yet, but they're making a lot of changes for the brand. So is Nike a buy down here? In my opinion, it is, but only for people who believe in the recovery story and only people who are willing to wait the few years required for that recovery story to kind of make its way into the actual financials. Not my favorite company to invest in right now. I'm looking for a bit more growth in this. But if I was looking for something consumer defensives, right, or rather, consumer cyclicals or consumer discretionary rather, and I was looking for one recovery story, Nike would probably be top of my list for consumer cyclicals. taking advantage of the recovery story, but at the same time, the possibility for the no landing, no recession scenario that the Fed has penciled out for the next 3 years, and progressive recovery of the consumer. So keep all of that in mind when you're evaluating Nike for your investment choices. That being said, we're now through all of that good stuff. Let us move in to the indexes and do some analysis on some charts. So in terms of the S&P, as we said, there's now a catalyst vacuum between now and the end of the year and even into January the 9th. And if we just go by the data that we've received so far, it's been relatively good, except for some of the articles, the hit pieces on some of the tech names such as Oracle and obviously the fallout from the Broadcom earnings. But at least we had Micron there today to kind of pick it up a little bit. The stock was up 10.21% on those beautiful earnings from yesterday. So bit of tech reprieve in the markets right now, a little bit of a give, a little bit of a take back, right? So you'll be looking tomorrow to once again attack this resistance range. If you look at the futures market right now, they're trying to make their way up into it, right? Just imagine the imaginary box right here that should be there, but that's not there. But let me put it for you guys right now. You got to attack this overhead range tomorrow, right? And even into the next few days, if you really want to see some good price action. Tomorrow, the only thing is it's a massive options expiration day. So don't be surprised if the market makers play a little bit of games throughout the day on some individual names. But the indexes so far look good. The one thing you do not want to do is crack yesterday's lows, obviously, right? But we do have a lot of support down here under us at about 674, down about 665 on the S&P. So it's a start, right? You got to kind of get the follow through on the trend change on the hourly time frame, right? You got to get that trend change on the hourly. If not, you won't be going anywhere quickly. But as I said, a lot of support right here. It's been the loss of the daily uptrend. Now you're consolidating. Now you're into weekly consolidation as well. But as I've been saying, right, you are in a nice weekly uptrend, and the bulls have just been looking for a higher low this entire time. Maybe we have found it with the lows of yesterday into the 12 EMA and into support. And if you do believe in the statistics for the good old Santa Claus rally, is it this one? Is it this one? No, this one right here. Well, you may just be expecting the continuation of the uptrend into the end of the year and maybe into the early part of January. Now that we're kind of through a lot of the sentiment disaster, right? Today did a lot of wonders for kind of bringing a bit more positive sentiment back into the market. You did have some pretty big lift here on some of our tech names overall. Moving on the QQQs right now, same context and same analysis, still in the support range right now. 614 down about 605 is that range. Once again, we will be looking for the trend change, right? Gotta get that hourly trend change underway into the regular time frame hours, not only extended hours, but regular time frame. They lost the daily uptrend. As a result, you need to get it back overall. And that all starts with the hourly trend change, and it needs to carry into the daily as well. So you got to get some expansion, man. And if you fall a little bit lower, well, we're still in the confines of weekly consolidation, right? It was a nice weekly uptrend, right? We almost lost it by closing below. And now the bulls kind of just need to get it back slowly but surely. So this entire attempt has been looking for a weekly higher low to reset the uptrend, perfectly reacting into the 12 EMA on the weekly. And you need to see a follow-through bounce. And if you don't get the follow-through bounce, you got a lot of support down here as well. The China tariff lows, the November lows, and that's roughly 596 down to about 588. So we got a decent amount of cushion before the weekly trends are in jeopardy. So the bulls are not looking too bad right now. We will see how we conclude the month of December. But so far, it's been 2 months of just kind of sideways consolidation action, which has been healthy consolidation for the markets overall. And it's more broad, right? It's a lot more broad than it was back at these previous all-time highs on the S&P. So that at least gives us a bit of bullishness leading into the end of the year and into January, now that we have the summary of economic projections and a bunch of other data that does support the fact that it's kind of tough to be bearish into 2026. And we talked about that a lot yesterday in terms of the fiscal policy coming into next year as well, and all of the other bullish catalysts that you may be able to see, such as your overall tailwinds for the market, right? The strong GDPs, the continuation of the rate cuts, and the end of quantitative tightening with the QE boost, which happened in December, $40 billion a month by the Fed, the relatively still low employment numbers, which we just got the other day as well, the low-ish inflation, which was reiterated today. But if you don't believe that, you can look at the Trueflation Index. It also still shows relatively low inflation. Retail sales were very good metrics yesterday. We talked about that as well. You can see that on the print right here, 0.8% versus 0.3%. And also you had the average hourly earnings at 3.7%, which is above the rate of inflation. So we don't really have any big macro that's currently falling off a cliff. You just still have a bit of timidness in the markets, right? The markets are very shy. The markets are very fragile right now. And the tech sentiment sell-off has not helped. But we were able to kind of see through that tech sentiment sell-off and determine that a lot of these companies are really attractive into 2026 because of their forward multiples and their forward earnings projections. Moving on to XLF financials right now, further consolidation. We had this one in the morning, early morning. Then we kind of gave it all back throughout the day, but this is just natural consolidation for something that's been in a very nice daily uptrend this entire time. We've been talking about this. Breakout, looking for the back test, right? The whole back test area is around 54. We're coming into that right now. So we'd be looking for the bulls to kind of just get some support down here and maybe go for one more leg. Nothing bad to see here right now. It's just a very nice engulfing move on the weekly and looking for a good old breakout retest on the daily and on the weekly timeframes into 2026. So I see no problems with financials right now. As a matter of fact, a lot of these charts kind of look the same, right? Visa, big breakout, and now you're just consolidating a little bit, right? You can consolidate a little bit more to the EMAs, but Visa, MasterCard holding on to their breakout patterns really well right now. And even some other names, right? Like JP Morgan had a huge engulfing move last week, and now just looking for the possible breakout as well on this name. Looking pretty good on the weekly timeframes are the banks and the credit card players overall. Moving into semiconductors right now. Semiconductors, oops, I don't know why there's one that's not there anymore. We're missing healthcare. Where did healthcare go? Sorry about that, guys. We're going to do healthcare first. So healthcare, not a bad day today, but still in the context of consolidation, right? Daily uptrend was nice. You lost it. Now you got to get it back. Overall, you lost it by flushing these lows, obviously. Now they got to get it back in 2 phases. So we'll see if they're able to do that. The weekly uptrend is still very much in control of your bulls right now. And even if you consolidate a little bit, your higher lows are all the way down there, 150. I wouldn't mind either way, right? Even if you come down a little bit here and consolidate this monthly time frame a little bit more, 148 to 145 is my key area, looking for more swing trade action on some of our favorite health games overall. And the MACD on the monthly has also crossed too. So the bulls are definitely in control in this one. Healthcare should be a pretty decent sector into 2026, in my humble opinion. After doing a whole bunch of nothing for the past 3 years, this one could be one of your outperformers into 2026 overall. And now moving into semiconductors. Semiconductors, a little bit soft today. I mean, they were up 2.36, but an inside candle with yesterday's action overall. So no change in trend, but we know what the bulls are trying to do here. It was a downtrend, huge engulfing move, and they're looking to set some higher lows. What better area to try that in than the support range below us, 345 down about 325 overall. They're just going to be looking to establish some form of support and maybe go for the trend change. If they can't get it done, right, in one clean shot, you got a lot of room here to kind of two-step this process as well. I wouldn't be too nervous, especially due to the fact that we never lost the weekly, right? So this was a massive move, big retracement, double top right there. And as I said, if you can't just continue this with one clean shot, maybe you just need a bit of sideways consolidation. They've done this a few times where they just didn't go for it in one clean continuation shot. Maybe this is just another indication that could be the issue right now. But there's a lot of attractive names in semiconductors right now, starting off with Broadcom, right? Broadcom, huge consolidation after their earnings, back into some of the September lows right now. And the forward multiples on Broadcom here at 325 are not that bad. It's a 1 peg. I mean, the price to sales is a bit high, but price to earnings is not too bad, right? So you're getting a nice little discount here on Broadcom overall. We also established that NVIDIA, very cheap down here on a multiple basis, extremely cheap. We'll cover that later in the video. And even names like AMD, right? So there is more room to the upside in terms of multiple expansion. And those are 3 of your bigger names in the whole semiconductor landscape. So if they have room to the upside, you got some room on SMH, and they do have room to the upside, both on the chart and in terms of multiple expansion as well, or rather just multiple recapture, because right now they're trading at relatively low value. So semiconductors not looking too bad. And last but not least, the IWM Russell. Well, today a bit of an inside candle as well, up 0.6%, but we know what the case was here. Daily uptrend, you lost it. You're trying to hold on. I mean, you move this box up or down a couple dollars, doesn't really matter as long as you understand what we're doing here. They're trying to hold on to it, but we did lose the uptrend overall. What we've been talking about here is that the bulls will need to get this back. The clearer time frame, in my opinion, is always the weeklies, right? Who's in control of these weeklies? It's the bulls. Big engulfing move, tons of space to set that higher low. Anything above 229, looking for your higher low. So anywhere between here and the 12 EMA pocket is probably where they'll want to establish those higher lows. And if the markets are kind to us into the Santa Claus period, you might expect the Russell to go on a bit of a move right here as they do control the monthlies. You did get your monthly back test during November. This candle right there. So the cup and handle and the breakout is still in play, although it has been choppy recently. So I see no big problems on the Russell right now. It's just been a little bit slow with that consolidation from tech that happened earlier on this week overall. And now we're just going to check on our minor sectors very quickly here. Consumer staples, well, we're still in the context of a nice daily uptrend. They're clearly going for something larger at play here. Nice weekly engulfing move overall. Nice support below us, 78 down to about 75. And what they're looking for here is after a beautiful monthly November close, you're looking for some further expansion into 2026. This is the no landing or soft landing trade, right? Consumer staples coming back. A lot of those names got destroyed the past few years, and now we might just be looking for a resurgence in some of your consumer staples or some of the value-oriented names. After having a very poor showing the last 2 years, it might just be time for the re-expansion of some sectors that just have been underperforming. This one I do indeed like into 2026 overall. And another one that I like into 2026 in light of those economic projections is this one, XRT, consumer retail, right? Retail has had a very solid push recently. Now, Nike didn't perform too well today, but there's a lot of other retail names that are coming off of their lows. We know that retail hasn't had the best time, but some of my favorite consumer retail names are probably in relation to travel, right? Booking.com, probably one of my favorite plays. Airbnb, probably one of my favorite plays into 2026 as well. Travel has been strong. Now, we talked about this, right? The airlines have been making significant pushes off the lows. Here's AAPL, here's UAL, here's Delta Airlines as well. All the airlines have been performing pretty well recently. And then you also have some, some of the cruise lines, right? Royal Caribbean has been moving higher a bit. Norwegian has been moving up a little bit. These charts, some of these charts are still kind of terrible, right? RCL is arguably the better one overall, but I'll be targeting the larger travel operators such as Booking.com and Airbnb. They have very solid fundamentals and broad applications, but you can find some deals here and there in terms of the consumer retail trade, or you would just pretty much go with the ETF and the recovery of the entire sector, right? We know that American Eagle has been forming really well. If you don't want to chase this one, if you don't want to chase names like Abercrombie and Fitch, if you just want to play the sector overall, well, XRT might be a very decent bet right here. I mean, the classic one, of course, is XLY, but keep in mind, most of this ETF, like 30% of this ETF plus 35% of this ETF is Amazon and Tesla. So my play for retail indeed is Amazon. It's my heaviest position by far. But if you wanted to go for something a bit more evenly distributed to where no position is more than like 2% in an ETF, you'd go for this entire XRT. Not too bad. I like this one in 2026 as well. Utilities, this one is going to be fire into the next few years as well, especially if you're focusing on some of the data center specific plays. Monthly, looking pretty good here for a back test and run. The short-term timeframes are still somewhat choppy because of all this consolidation from some of the data center specific utilities plays, which hold some decent weights in those indexes. It's a weekly downtrend into support, but at the same time, they're just looking for monthly higher lows. I think utilities should be a pretty big winner for a couple different reasons. Number one, the rate cuts, obviously. Number two, because of the data center plays and some of the utilities plays that we've been talking about recently. Vistra, not too bad right here. Duke Energy, not too bad right here, right? Some other people bringing up Dominion. Dominion is pretty decent as well for a play on the data centers and other things of that nature. So, some of the electric utilities plays that are close to the data centers and that can provide them with that power. And lastly, a few more. Actually, one more. Real estate. Real estate going to be very interesting, guys, into 2026. As you can see, it's been doing nothing, but there are a few opportunities out there. If you like REITs, my favorite REIT in the world is probably Vici right now. 3 years of support, 4 years of support, guys. Decent, attractive level to lock in that juicy 6.34% dividend. This is the landlord to the suite of MGM hotel, casinos, and resorts. So they don't really care if there's many people in Vegas or not. They collect the rents. They raise the rents all the time. And their tenants will probably not default on their obligations anytime soon. So I like this one. You might be able to see some renewed bullishness into the REITs into the next cycle, right? The next 1-2 years. So I like these ones for REITs overall. Vici is probably my favorite, but I also really like the mortgage companies. And we've been talking about Rocket Mortgage for the better part of the last 4 or 5 months at this point. I like these mortgage companies into 2026, 2027. So that being said, guys, that's everything for your overall market rundown. The VIX plummeting today because, the CPI came in decent and there was no extra news, extra drama from the tech sector overall. So the VIX remaining at a pretty chill location. You'd be very surprised to see this much before January the 9th, right? Because there's no news catalyst. When there's no news catalyst, you can't really be crossing your fingers and praying that something crashes the markets, right? So that being said, I would expect the VIX to remain fairly muted over the course of the next 2 weeks as you don't have any economic releases, but anything can happen at any time, right? It's just statistically and probabilities wise, you're not really expecting much from the VIX overall. In terms of our yields, the yields are still very bumpy right now. No secret there. We've talked about that so many times ad nauseum on the channel over the last few months. TLT just will not increase, guys. The long-term bonds will not go up until the bond traders and international parties are sufficiently confident that the U.S. debt is not a problem, right? That they'll be paying it down with tariffs. And number two, that inflation is finally out of the way. That's why the 10 and 20s are trailing so far behind the 1s and the 2s. Jerome Powell has been talking about this for like literally 3 meetings back to back at this point, to where they don't really influence the 10 and 20-year yields, right? Those are market participants' perception of risk premium associated with investing in US national debt. So keep that in mind as well. Moving on to gold right now. Gold, I mean, they tried the breakout here, couldn't get it done, right? Which just leads you to believe, right? It's not an environment like this. This was central banks, but also some of the major stablecoin players, such as Tether and Circle, buying a lot of gold because they'll be offering, gold products essentially. So they need to build up their reserves. So there's a lot of central banks here as well. And since then, the central banks have tapered back their purchases a lot. So this is just led by bullish momentum and a lot of retail participation as well. So as a result, you're still in the context of a bull uptrend right now, but it's just not as violent as it was back here. People are expecting a squeeze like this again on the price. I'm not really expecting that. Maybe just a consistent move. So pay attention to your time frames here. Anything above 41.67, looking for a higher low, maybe into the 12 EMA, maybe into the top end of that range right there for probably some consistent returns on gold overall. But just be careful, right? Because you are daily overbought conditions right now. You are weekly overbought conditions again, right? Again, which this is bearish divergence. Let's be honest, if they make a newer high, right? Bearish divergence on the price. And also the monthly timeframes here, guys, they're super overbought conditions, arguably some of the most you've seen in gold. So just be careful. It's a very greedy long up here. So if you are taking some longs, trade it with the stop loss if you are trading the asset, of course. And now on to Bitcoin and Ethereum. So more manipulation in crypto. They've been manipulating this one a lot. First was yesterday. Huge manipulation on the price, clear manipulation. It is what it is though, right? Crypto is not, crypto is not, I mean, it's regulated, but there's a lot of manipulation, trust me, by a lot of the bigger market participants. And today as well, start off the day nicely. Bitcoin was up like 2-3%. Ethereum was up, 5% on the day, so 4-5%. They unwound everything, absolutely everything on these. So straight manipulation at these lows, liquidating the shorts, liquidating the longs, liquidating the shorts, liquidating the longs. If you go on Twitter, every day you'll see how much money they're liquidating from the leveraged environment in crypto right now, which has just made the current price action and short-term trading very difficult on these assets overall. They're still holding some of these lows. I mean, despite losing the daily uptrend on Bitcoin, you're still holding. They have a chance, not a very big chance, but a chance of trying to go for the weekly uptrend. This bounce on the weekly was very soft. We've been talking about this. It was a 38% bounce, very soft. It means that the bulls don't have much of a chance of doing this. But the probability is not zero. They have like a 30% chance of converting this into a uptrend. Now, obviously, if the rest of your markets are supportive for some expansion over the next 2 weeks, Bitcoin has a much better chance. And we were waiting for the Bank of Japan decision. It came out. We'll be waiting for further commentary. The markets are responding well to this, apparently not getting destroyed by the yen carry trade unwind, at least not just yet. So Bitcoin is not looking terrible, but very tough to take some longs right here. If you are taking some longs, you really got to put a stop loss below these weekly lows, because the last thing you want is getting completely unwound and revisiting the lower support, which is about 75. And same concept on Ethereum, right? Ethereum lost the daily uptrend, very clear right there by flushing these lows. They're desperately holding on to the lower bound of support right now, which is about the 2,800 location. So the bulls, I mean, there's a chance. There's always a chance, right? There was a 50% bounce, but most of the price was contained below the 38. So, I mean, you can say it's a 50% bounce on the fib, but, is it really? We didn't really maintain that much over there, right? It lasted for like 12 hours. 24 hours maybe. I mean, it did make it there, but still not the best price action. That being said, right? No closes above the 50, which is what you want to see on the daily timeframes. So that being said, there is a chance that Ethereum bulls can reverse this into a weekly uptrend, but you will need to see a break at this point of 34.30. So we'll keep that in mind. Crypto will move with the overall rest of the asset markets. So we'll see what we get. The moral of the story is Bitcoin and Ethereum can be very decent bets for long-term positioning purposes, for expansion of the overall asset markets into the next few years. But swing trading them right now is a bit difficult, and you should be doing so with the stop loss below your weekly lows. That being said, that's everything for your overall market rundown. Now let's dive into big tech names. We're going to start off with good old Apple. Well, Apple, they played some games with this one today, man. Look at the open. Huge flush on Apple right here. Right at the open, we opened, well, with pre-market was okay on Apple. But look at these algos, man. Look at these algos. No news on Apple whatsoever this morning to trigger that. They were able to kind of get it back, and you can see the price kind of normalize into an equilibrium the rest of the day. What did they tag? well, maybe the 12 weekly EMA that we were talking about, right? So these levels, they do matter. Apple was in weekly overbought conditions. The entire time we've been searching for the end of this daily downtrend, and it's been a daily downtrend with now the lows in reach, right? 267 overall. That being said, nice weekly consolidation on the price right here. However, on the monthly, it does remain somewhat extended. So if I'm looking for some larger swing trades, I mean, there's one tiny little trade right here. If we're trying to go long right here and trying to say, okay, that's your weekly lows. We tag the 12 EMA, maybe a bit of follow through with the rest of the market into the Christmas. If that's the thesis, it's not bad, but you are going counter trend on the short-term time frame. So if you are doing that, the stop is below the lows at this point. It's always been below the lows, whether we were positioning in the last few days or today, but now they gave you, right, the straight shot to the downside here. So they printed the lows right there, and you now have a nice demand area that's formed. And as a result, if we're taking any longs on Apple, your stop is below these levels. Your take profit is into the 300 psychological. So the risk reward on this one is not terrible for a short-term swing trade. It's a very greedy trade. And the reason that it's a very greedy trade, I mean, it's a 4-to-1 risk reward ratio at this point in time. It's very greedy only because of where you are on the monthly time frame, right? And the fact that the weekly is also quite extended and kind of curling down on the RSI. It doesn't mean that the trade can't work. I'm just saying it's a very greedy trade because it's not as if you're trying to make a trend change attempt from down here, right? No, you're just trying to push the price exponentially higher. And as a result, the valuations up here, or rather, also the valuations up here are somewhat rich in the 270 region. You're trading at above a 3 peg right now. That's why it's a very greedy trade. If I'm looking for some bigger positions, if Apple somehow drops down here in the next month or so, for any which reason, I'll be looking at a position on Apple for this beautiful breakout retest trade that could be in the cards. 255 down about 243. If I don't get it, I don't get it. No problem at all. There's tons of other names on this list that are establishing a pattern that I like to trade, right? And one of them is AMD. So AMD coming up here, 1.49% up on the day, inside candle with yesterday's trading action. Daily downtrend, so the bulls need to stop this and reverse into a new daily uptrend if you want to be able to say your weekly lows are officially set. That being said, it's not the best, right? You wouldn't be surprised if for some reason AMD does curl down here. That's going to need a lot more tech weakness. If the rest of the markets are okay, well, then maybe the bulls can put a save here and not crack these November lows overall. The weeklies, right? That's why it's always confusing. You got to kind of reconcile where we are with what we can do in the next few days versus the price, right? So if the markets are bullish, you wouldn't expect them to crack these lows. That being said, the retracement size right now is only 38.2%, which is why I say it's just like Bitcoin, right? They have a chance of doing this, of not cracking the lows, right? It's not a very strong chance, but with now all of the macro events behind us, no more big catalysts on the horizon unless you get another hit piece on Oracle or any of the other AI big names out there, well, maybe you can put some credence behind this push higher, right? But if it doesn't happen, this would look very logical. Weekly downtrend into our 190, 175 support, and also the monthly. This would be a very nice monthly breakout retest pattern culminating in the support area and the 12 EMA. So I am selling puts down here. If it gets down there, perfect. I'll end up with some shares. If it doesn't get down there, perfect. I end up with the premium. But however, if you're looking to buy some shares here through this range, we're not sure if it's going to go down there, right? But where can we start buying? 200 psychological down into there because we know we have good valuations. It's under a 1 peg on a forward basis, and the growth thesis is still very much intact for this very nice stock. So that's what I'll be looking to do myself personally. Moving on to Amazon right now. So Amazon up 2.5% overall, still getting rejected at resistance though. 240 down about 228. I mean, let's call it 240 down about 230. This whole location, right? It's very clear rejection area, right? So the bulls need to do a lot of work here. This is a daily downtrend. You need to reset the uptrend. That'll set your weekly higher lows. And then we'll be once again trying to change this into a new weekly uptrend into the end of the year and into January as well. Very choppy price action on Amazon, I will admit. But if you look at the longer term timeframes, it should be very clear what's happening right here. It's a nice monthly uptrend with some back tests into the 12 EMA. Very large support as well, and we might be looking to move higher into 2026. Why higher? Well, because they give us phenomenal earnings, and the valuation can see some multiple expansion, 28 forward PE and a 1.4 peg with beautiful earnings guidance, not only for next quarter, but for the next few years, right? Amazon's going to be doing really well. Look at this EPS expansion they're embarking into, and look at this revenue expansion as well. Very consistent. As a result, shares for me, yes. Selling put options below the price, yes. And also leap call options, I am going for too. Moving on to Google right now. Google, 1.91% to the upside, but still in the context of this daily downtrend. Now, the lower support area is down here. It's about 291 to 272. Not the strongest area, but it's the only one that we have because Google bulls didn't really bother setting much on the way up. You got this guy down there, you got this guy down there, and that's it. So this area lines up with the 12 EMA on the weekly. Very extended on the price, still weekly overbought conditions. Monthly, it's all the way up here, guys. Monthly overbought conditions, super far extended. So am I buying Google up here? No. Am I holding all my long-term shares? Yes, because I'm holding my long-term shares for the next 5 to 10 years. But are there any swing trades up here? Arguably, no. It's a very greedy long up here. And as I've been saying, if you are trading Google call options, you're seeing a lot of gains right now, or you were trading shares and you're seeing a lot of gains. Trading shares, not long-term shares, it could be nice for a bit of a reposition into some of the other names that have been lowered in the last few weeks since the November sell-off overall, as right now Google is kind of clipping into the higher end of its historical multiples. Moving on to Meta right now. Meta, a nice 2.3% day to the upside. Meta bulls are really trying for it, man. They're looking to defend this whole area, right? 640, we never broke it. Daily higher lows were retested, looking for the re-expansion back into resistance, 679 to 706. On the weeklies, not looking bad either, right? It's been a weekly downtrend. This has just been kind of sideways consolidation, looking to set the new lows, looking for it, right? Go for the weekly re-expansion trade. We will see if they have it in the cards. If you do break above this area right here, 676, this is a fake wick. The price never traded there, right? I don't know why they have a big wick up in here. It never actually happened. So please keep that in mind. That being said, okay, we're looking, or rather up in here until 700, right? We wicked into there, but never wicked up in the 700s, right? So looking for the re-expansion of the trade. Monthly has been very clear for me so far. Monthly backtest here, the clearest time from them all, right? Monthly 12 EMA. So I've been accumulating some meta shares as we've been down here. Leaps are also on the table as well. Short-term swing trades, you got to do so with a bit of caution. If we are swing trading, you'd be going for a stop loss down below there. And I take profit probably at the top end of your resistance range. Not too bad, but Meta's valuation is quite attractive right now in around 630, where we kind of are right now, you know, plus a few percentage points here and there. Not going to change the multiple more than that. Low 20s multiple, 1.6 peg, very attractive on Meta for the future. So leaps and shares, I'm a fan here, but you know, I can never recommend leaps. I'm just telling you guys what I'm doing, right? Leaps are never a sure thing, but when I see a good risk to reward profile at a nice monthly backtest like this, I'm probably going to go for it. Moving on to Microsoft right now. Microsoft, not too bad of a day, 1.65%, but once again, getting rejected at resistance. 500, down about 490 is the resistance range. Challenging for the bulls recently, right? As it was support in the past, it is now a resistance currently. And that being said, your lows are now set. Daily was a downtrend. Lows are set. You got a nice bounce. You got to reverse this. Got to give me a daily uptrend. That's the only thing that tells you, yep, weekly consolidation is done. And maybe, just maybe, we can set these weekly higher lows and go for the weekly trend change, which would require a break and close above 491. You change the weekly uptrend, you have officially set your monthly higher lows. And maybe, just maybe, Microsoft can embark on the subsequent rally from these levels. Now, Microsoft is a few different things for me right now. It's been short puts from the whole 470 down to 450 range, which I've talked about many times on the channel in the most recent few weeks. They've been very profitable swing trades for us, or rather short put trades, but also shares at 470. You're trading at a 29 price to earnings, a 1.66 peg. So the valuation looking a lot better than it once was at 550, 560. So shares for me, yes. Short puts out of the market as well for me is a yes. On to Netflix right now. Netflix down about 0.83%. We covered the news yesterday that, you know, that a few people from the Paramount team were choosing to back out of the deal, such as Jared Kushner's firm, etc. The Ellison family unable to confirm the deal so far. There was a bit of drama surrounding that. Warner Brothers put out a memo to its shareholders saying, yeah, we don't really want to do the Paramount deal because the Ellison family is doing some shady things. Jared Kushner's firm backed out of the deal. And overall, we do think Netflix is going to be a better candidate. At the end of the day, it does hinge on shareholders voting this one through. So we'll see. Until that deal is finalized, I still think there will be a lot of push and pull on the price right here, which is why you've done a whole lot of absolutely nothing this entire week. However, although we're doing absolutely nothing, it is noteworthy to understand we are very close to daily oversold conditions. On the weekly, we are super low on the RSI. Usually when Netflix comes this low on the RSI, unless it's a 2022 bear market, usually it has been very close to a local bottom on the stock, as you can see from those multiple events throughout history. And additionally as well, guys, I mean, it's 30% off the highs, right? Sure, it's a bit of a monthly slide right here, and we are into the 26 EMA, but usually buying Netflix around the 26 EMA is a fairly good proposition, at least if we look at historical standards. and historical price action history. That being said, at 95 right now, it's under a 34 price to earnings, a 1.47 peg. So Netflix, a few things for me right here. It's going to take a while to turn around this chart. Trust me. You're going to need to get through the deal drama, right? You're going to need to confirm the new daily uptrends. You're going to need to get a very nice weekly bounce underway and eventually reverse this weekly time frame too to be sure that your monthly lows are set. But I am bidding here for a few different things. Number one, I'm selling some put options below the price. I'm buying some shares, and I'm also buying some leap options because I do think this sell-off on Netflix is a bit overdone at this point. Moving on to NVIDIA right now. NVIDIA, solid 1.87% to the upside. So holding support right here, 171 down to 165. We keep talking about this one, right? The price action has been not so favorable recently. We know that. They tried to go for the daily uptrend, got rejected, got brought down by Oracle, by Broadcom, by a few different hit pieces on the AI names. And overall, this one's just been very sideways and just very soft, right? Weekly lower highs are here at 188. Equal lows, no weekly downtrend. The bulls are saving it, right? No close below 170 just yet. Break 187. It's a new weekly uptrend. Look at that. New weekly uptrend. And that'll be the end of your monthly consolidation, which we've been talking about for a while now. This whole area on NVIDIA, good for a few things. If you're a fan of leaps, you can do leaps. I'm not giving financial advice, but when we come down to the 12 with good valuations, usually that's when I like doing leaps. Now, this is leaps. This is also a shares trade because of the low valuation. It's a one peg at a 23 forward multiple. Not that bad on NVIDIA, right? It's cheap. And additionally, you are having the ability to write some short puts below the market. We've been writing short puts on below the market now for the past literally month and a half. And it's been a very profitable endeavor targeting this whole mid 160s, low 160s area. I would not mind being assigned there. So a lot of different trade opportunities are on the table for NVIDIA right now. Moving on to Tesla. Tesla, 3.45% to the upside. They challenged 490 again. Couldn't get it done, but the bull's looking pretty good, right? You got this big old daily uptrend breakout towards the all-time highs. And now if they do consolidate, well, where can we come down into? Maybe 460 to 442 for a bit of a back test on the daily, but also on the weekly time frame as well, right? Weekly downtrend, nice engulfing move. If they choose to back test, this would be a very logical area for them to do it as the weekly 12 EMA catches up. You're going for the good old cup and handle trade, right? The breakout retest, cup and handle trade for possible further expansion beyond 500, unless they just take it up from tomorrow onwards, right? And then you just won't get the back test. So next target is definitely 500. It's a very greedy trade going long on Tesla right here for either short-term trades or even long-term shares at this moment in time. So I'm just not positioned on Tesla for any short-term swing trades. On to our few last ones right now. Palantir up 4.74% today. They've been struggling with this whole 187, right? Equal lows. We were in jeopardy of getting into a daily downtrend, but equal lows, right? So these lows are definitely the ones to watch. 177 on Palantir. It's not looking too bad for a bit of a breakout, right? They did something similar like this all the way back here. There's been a big chop zone, right, for Palantir to break out of. We'll see if they can actually break out of the whole 185 area. On the weekly time frame, it's not looking too bad so far. This is a very nice bounce. The bounce matters a lot, 618. It matters a lot because you lost the weekly uptrend, right? You lost it by flushing these lows. So now you got to get it back, which is why I've been saying any loss of the daily uptrend into consolidation, they're just looking for a weekly higher low to possibly go for the uptrend shift into 2026. The monthlies, not looking too bad either, although it is a bit choppy. We did come and back test our support 150 to 140. So Palantir, nothing for me to do. I'm just still holding my long-term shares that I have in this business, but no swing trade longs from here. The risk reward is not proportional. It was proportional down here, which we were talking about, right? But not, sadly, they didn't visit it for too long, right? You would have liked to see them hover around here, kind of establish a bit of a tradable range down there, but they never did it for us. So unfortunately, this one is a trade that I did not initiate, but I am still holding some of my long-term shares on the business, even though the valuations are indeed still quite very high. Moving on to SOFI right now. SOFI up 4% on the day. Nice recovery, but just an inside candle with yesterday's action. Not too bad, though. Similar to the rest of the market, SOFI's trying to get the hourly time frame back, right? Then you got to make a push on the daily. Where do you got to push above? You got to push above this guy right here, 2740, right? And then reverse the daily uptrend, and that will put an end to your weekly consolidation phase. I mean, they never set the weekly downtrend, right? The higher lows were here, 2354, lows of November. It's just consolidating sideways, right? The bulls are just trying to set some form of a higher low with this very nice bounce, super nice bounce size, trying to set the higher low, trying to go for the uptrend break. But this whole area has been super choppy. Now, in a very choppy area, especially one above a huge support area, 25 to 22, there's one order type that's very good for us, right? Previous resistance, support right down there. So I've been selling the heck out of some short put contracts down there. We've been making a decent amount of money just doing that, just selling put options in the 25 to 22. If it comes down there and assigns us, great, I'll take the shares because it's big support and it's a fair valuation. If it doesn't assign us, great, I'll just collect the premiums, right? Super easy. But also here has been a good area to accumulate more shares if you're looking to hold SOFI for the long-term prospects of the company, for them to expand into a, 45, 50, $55 billion company over the next few years. It is indeed possible. The market cap right now is about 33, and the forward multiples are not that bad either. Two last ones, Uber right now. So Uber trying to get a bit of a bounce going today. Oversold conditions. We'll see what happens. This is bullish divergence, right? So that being said, plus oversold conditions, plus the divergence, plus this massive resistance, which is now support area, plus, right, the monthly consolidation phase underway, all leads me to believe that this is a very attractive, just nice buying opportunity before a possible rally into 2026. The forward multiples support that as well. You're trading very cheap on the price right now, 23 forward PE, a 1.43 PEG, and a 5% plus free cash flow yield, which are all very good things on Uber. So what I'm doing on Uber is a few key things. Number one, adding a little bit to my long-term position on Uber, which I've held for years at this point. But whenever you get these nice monthly pullbacks and the valuation makes sense, I am a fan of just building out the Uber position a little bit more. That being said, the weekly is still a downtrend. The daily is still a downtrend. So the bulls have a lot of work to do before we can call this the actual bottom. But while it's down here, shares and selling put options, not the worst way to play this stock, in my opinion. And last but not least, Taiwan Semiconductor up about 3% today. They've just been reacting from the support range, right? 280 down to about 270. It's very choppy, right? This whole area is just massive choppy area on the weekly, kind of similar to what they did back here. That being said, they're moving nicely with the EMAs, kind of like the SMH ETF overall. No new weekly lows, right? Equal highs, but no new weekly lows. So it's just kind of a range, right? Kind of accumulating the price right now. On the monthly time frame also, this has just been sideways consolidation. The 12 hasn't curled up fast enough for us. We haven't had much of a bigger pullback either, so I can't really play some of my heavier positions that I like to do when we find confluence with the 12 EMA. But that being said, is TSM expensive up here at 275, 280? Not really. It's low 20s multiple. It's a 1.15 peg. So I am holding on to all of my shares. And as we've been in this area many times over the past few months, right? I've been saying that it's not a bad proposition to be nibbling on TSM shares up here. I wouldn't be selling my shares. I'm just not going all in at these prices right now. And also no larger swing trades for me. I'm just playing other names with better technical setup entries, right? But there's nothing wrong with this business. Phenomenal business, great pricing power, great margins, and they should be having a very nice next few years ahead of them. That wraps up all of our market rundown and all your big tech names. Hopefully you enjoyed that. Now for the last section of the day, let's talk about the biggest gainers and losers of the day. We're not going to be doing all of them, just some that I feel could be interesting trades here into the foreseeable future. Okay, so to the downside first, we're going to talk about a few key themes here overall. Now, Oscar Health and the other players like UNH and Molina Health and other things of that nature, right? It's going to be very choppy, guys, because they're trying to redo the entire Affordable Care Health Act, right? So the LACA trade is kind of in a very big washing machine right now. A lot of turbulence around this trade. So if you are building positions in this trade, whether it be Oscar Health or UNH, you guys should have a very long time horizon, and it might get very bumpy surrounding the January period of time where, once again, it's going to be a question of the government shutdown surrounding these ACA subsidies and all things of that nature. So just remember, if you are bidding something like an Oscar Health or these other ones down into their support ranges, you may have to wait again for a long time and more sector clarity before you get the next round of upside overall. But Oscar Health, not the worst opportunity down here, 13, 14 area. I'm not playing it much myself anymore. There's many other trades on the table. But for those of you guys that are playing it, I just want you guys to understand what the landscape is right now. You should probably not be expecting many rapid gains to the upside, right? Speaking about the home builders, Lennar has been coming down after the most recent earnings overall, which show that these home builders have been issuing a lot of incentives recently to kind of stimulate demand once again. That being said, if you don't want to play them individually, I would be a big fan of maybe bidding the XHB Home Builders ETF overall. 103 down about 98 is a decent liftoff location. Monthly, trying for the monthly higher lows and going for the expansion. This is a multi-year expansion trade, right? Into 2026, 2027 with the reduction of interest rates and the rekindling of the home market, which has been kind of lagging the last 2-3 years, obviously, right? So home builders could be an interesting theme to explore into the next few years. them and the mortgage companies overall as well. Take a look at some of the other names here that were on the lows. We'll talk about some consumer discretionary names that I like a lot. So Elf Beauty is one that I wouldn't mind accumulating more, either from here all the way down to the lower 60 range. Just looking for consumer discretionary spending to uptick. Once again, a multi-quarter, multi-year thesis for the consumer recovery trade right there. We didn't do the valuation at 77, but if you just take off, what is that? The last time we did it after earnings was 92. If you just take off, what, 15% from these, it's trading under a 20 multiple in terms of forward PE, and it's trading like around a, like a 0.75 peg, which is super cheap, and price to sales is super low for Elf Beauty as well. $4.61 billion company. So this would be one of my favorite consumer discretionary plays if I was looking for something, because the trend for Elf Beauty has been very good. It's just been a very tough cosmetics landscape overall, but this is definitely one of my favorite cosmetics player, actually my favorite cosmetics player in that entire niche. And it has a very low market cap as well. So I'm looking for some expansion. So rather than playing the food companies like Chipotle or other things of that nature, I'll probably be playing something like an Elf Beauty, maybe a Nike. I'm not sure, but Elf Beauty is going to be one of my only consumer discretionary bets, just because I do believe there's a lot of lift on this trade, right? Much more lift than possibly taking Chipotle back up from a $50 billion company to a $100 billion company again. That needs a lot of money, right? It takes a lot less to 2x Elf Beauty on the price than that. So just something to explore, although the price action has been very bumpy down here a little bit too, right? Speaking about other names that should be on your radar, SPGI and Moody's, they're currently trying to break out right here, rejection and resistance. But, this entire region, guys, I mean, they've been flat for like a year, right? This one, Moody's Corporation, have been flat for an entire year. I do believe they'll have very nice 2026 and nice 2027 expansion periods, at least because of their debt repricing pipeline. So all these businesses that will have to refinance their debt when interest rates do make their way to the downside, they have a huge debt repricing pipeline through 2029, and it could be very accretive to their business overall, since that's how a lot of these companies make most of their money. Take a look at the fundamentals here, right? Look at this EPS expansion that Moody's is embarking into, and revenue expansion as well. And the same thing for SPGI. So these two financial corporations, and even names like we talked about before, right? Visa, MasterCard, beautiful breakout retest opportunities right there on Visa, MasterCard. Even just buying some shares here and carrying them into 2026, 2027 after a year's worth of consolidation while improving fundamentals and at historically low valuations. Those are some really interesting names. We can bring up MSCI as well. MSCI hasn't done anything for literally a year plus at this point, kind of in that same category, but even MSCI, there could be a little bit of a catalyst here for some upside. And even in some software names, right? Some software names that have been beaten down recently, like Adobe. Adobe, we did their earnings a few weeks ago. It's good risk to reward. I mean, the AI black cloud overhang is still there, right? For names like Adobe, for names like Salesforce overall, not too bad in terms of software plays. If I'm going for one software play though, you guys know that I've been building a bigger position right now in UiPath. I like UiPath. I figured I should bring it up right now. We're looking for a back test here into the 15. So nice area, guys. It's been accumulating on the price a lot, and they're going for the monthly breakout retest right now. And they had really good earnings. Now, unfortunately, the market sold them back off after earnings because everything that was associated with AI, this is an AI play as well, anything AI associated got really sold off hard the last 2 weeks. UiPath is no different, but great area to be building some positions on this fantastic company. I'm not going to give you guys the full investment thesis in today's video, but the earnings made me extremely bullish. We've been in since here, and I'm building more and more positions here. It's probably going to be one of my biggest trades in my accounts leading into 2026, 2027 overall. So I figured I should give you guys a bit of a tip on that. My Discord members know, but I know that you guys don't know. In terms of other names, Rocket Lab, super strong push on Rocket Lab. They had a really nice expansion. We got a bit of a back test right here, and now you're just looking for further weekly expansion overall. Rocket Lab is a long-term thesis play. It's a $32 billion company. We got some really bullish news catalysts on their Neutron rocket launches into 2026 overall. And you guys know, right? In terms of space players with the SpaceX IPO, right? There's not going to be many other ones to pick from. There's this one. There's ASTS. My favorite one is Rocket Lab. There's Planet Labs as well, which some people have been talking about recently. A very small cap player, $5.5 billion. Look at this chart. Massive growth right there as well, right? But Rocket Lab is also one that I would not mind carrying into the next few years as a theme, right? Because obviously we know that there will be more and more developments into space, whether those are for satellite networks, for communications, or the infamous data centers in space trade. Rocket Lab is probably front and center for me overall. Micron we covered yesterday. There's nothing new to see there. Affirm also one of probably my favorite consumer discretionary bets. Many different ways to play consumer discretionary. Affirm, probably one of my favorite ones. Look at this monthly, guys. Looking for the monthly upswing, right? So into 2026, 2027, I do believe Affirm is really well positioned here. We've been bringing up on the channel, right? This whole lower 70s to 60s, it's not too late. Whether here and accumulate down into the trade type of thing, right? Looking good on the weekly, right? They're going for the weekly uptrend breakout. They haven't had the weekly uptrend, guys, in an entire quarter. They're going for it now. So pay attention to this one. Affirm, one to watch into 2026, 2027 as well. I am building some further positions into Iris Energy, just buying some shares, loading up some shares. We're very close to the 12 EMA here, down through the 12, which is like lower 30s, right? Here through the 12, I think the valuation now has compressed a lot in terms of the forward growth prospects for the company. This one I'm building into, NBIS I'm building into, very close to the 12 EMA. I'm building here shares, and also I have some call debit spread leaps on the table right now for NBIS. These two I'm building into right now, and also some newer names in my portfolio, such as FLNC. I'm building into this one as well. Here, all the way down through support, which is 16.15. I'm building into this one. I'm building into Ondas as well. This one here, all the way down through about $6. I'm building into the trade overall. We have some nice monthly consolidation upon us. So here through the 12, I am building in this area of consolidation, and a few other key names that I haven't brought up on the channel so far, but I'll just give them to you guys. TE Energy. TE Energy is probably one of my biggest plays now in terms of small caps. We're looking for big money on this one overall. We've been accumulating in the Discord from 4 all the way down through 3. So a lot of our guys are up pretty big on this trade already. It is not too late. Really not too late for TE Energy. I won't give you guys the full thesis, but it's just vertical integration of solar in the US for data center purposes specifically, but also these are the only other people that also manufacture the good old solar panels for space purposes as well. It's a multi-pronged thesis. I highly suggest you guys look into it if you do enjoy it. Here, down through 5, not bad. If you're looking at this chart and you think that you might have missed it, no, you didn't miss anything. It's a $1.47 billion company right now. And look at this growth on TE Energy. I haven't spoke about this one publicly on the channel, but I figured I should give it to you guys. If not, you guys are going to hate me for showing the massive gains without you guys being in. Look at this massive expansion, right? Vertical integration. Their CEO was seen speaking to JD Vance as well. So there might be a bit of a government play here, possibly in terms of support, but you know, trading under its forward revenue by a lot. Looking for some big expansion on this one. I'm looking for like a good 5-10x on this one over time. So I figured I should bring it up. Kraken also, my proxy for an Anduril trade. I haven't talked about this one either on the channel too. So Kraken up 2.44% today. This one as well. Small cap company, $1.29 billion. What I'm going for here is just basically companies, small cap companies with revenue. Okay, with decent revenue projections. Look at these revenue projections into 2027, looking pretty good in terms of some expansion here. EPS, not moving bad at all either. They do pretty much underwater robotics for Anduril. If you guys don't know Anduril, I highly suggest you look it up. This is a very niche play for another aspect of either defense and, you know, robotics, stuff like that. So I have Ondas, I have Kraken, and a few other smaller plays like that. But I figured I should cover these ones for you guys overall. If you guys are interested in the CFRs of the world or the APLDs, that's up to you. I'm personally building in IRN and NBIS myself. Those are just a few ideas on the table right now. And everything else, guys, I mean, we've kind of covered almost everything on this list. You guys know Vistra. I'm a big fan of Vistra here. If you guys are looking for energy plays, 12 EMA backtest, looking really good for some expansion in 2026, 2027 overall. And I think that's it. If not, I'll make this video like 5 hours long. I think that's it. The rest of everything we've kind of covered already for the most part. You know, you got some nice backtests here to watch out for. VRT down to the 12 EMA, selling some short puts or accumulating if you guys want some shares. I mean, the valuation down here at about 140 is not that bad anymore. Big data center play right there at ANET as well. Probably one of my favorite backtests here of a 12 EMA for possible swing trade longs into 2026. They're kind of right there, right? So either selling puts or accumulating a little bit of a position. Not too bad overall. Those are just some of the trades that I'm kind of watching out for into the future for everything data centers, some of the consumer discretionary plays. Melly, I keep bringing this one up, guys. Melly is a buy for me, at least, not financial advice. it's a buy. Forward multiples are just too cheap to ignore at this point in time. So this is an international consumer discretionary play, I assume, but it probably will get carried with the rest of the market higher. Their expansion is absolutely nuts right now. New Holdings is one that I was watching for a backtest of 15. I don't think we'll get it, but this one also I'm very bullish into 2027, 2028 overall. And Grab is another position that I'm slowly building pretty sizable shares position in for the longer term future, looking for the expansion of this monthly time frame here and the expansion of the business overall as they continue to do very good things in terms of moving into profitability, both on an EPS standard, but also revenue. The revenue scale is quite attractive right now for this company overall. So we're just looking for some price expansion right there. So those are all the names that I'm looking at. Rather than running you through the entire list right here, I'll just keep bringing up different names, especially smaller names that I'm building into, like TMDX as well, this organ transplantation business, right? I'm building positions in shares down here in the lower 100s. I hope they keep it down here as much as they want, as I do enjoy this thesis for the long term. Additionally, one that I haven't talked about much on the channel, but the thesis is pretty clear here. You're going for the EPS flip into positivity, and now you're also going for the big revenue ramp. It's about a $4.14 billion company. They're expanding into the kidney market. Now they do liver, lungs, and hearts, but they are expanding into kidneys, which is the largest transplant business on the planet. And they are expanding now into Europe after proving their business model in the United States over the past few years. So this one still a bit early in terms of this medical devices play overall, right? So there's a few ideas here and there. Those are just the main ones that I want to bring you in terms of themes into 2026. So as you see, guys, I'm not trying to give you guys, I'm not saying like buy APLD calls tomorrow for 1 month out. No. We're looking for themes, positioning for broader themes here into the future. So hopefully I was able to make some sense of those themes for you guys, at least the ones that I'm playing currently. So we'll see what we get tomorrow. The futures aren't looking too bad. So far, no Bank of Japan commentary. It's now midnight Eastern. I stayed up really late just to get you guys that Bank of Japan news because I won't be here tomorrow nor on Saturday. I'm kind of leaving, for my birthday weekend, essentially, right? So I will see you guys on Sunday for the top 5 options play, but I figured I should give you guys a lot of context into the weekend, just in the event that you wanted to watch this video tomorrow. You'll be able to do that and make sense of where the markets might be. Just pay attention, guys, right? The SPY and the QQQs, they're trying here. But, if you get a bit more consolidation, it's not that big of a deal. You don't have any big other catalysts much before January the 9th, and they're just going for the slow weekly upturn recapture, and you have your statistics here that you can rely on as well in terms of the Santa Claus rally. Not looking for 3 negative years in a row. Hey, maybe it's the first time. Maybe it's not, but there you go, right? So nice consolidation, many opportunities on the board through whole various different sectors overall. So hopefully today's video enlightens you on some of the themes that I'm looking for into 2026, whether it's on tech, we went through all of tech, whether it's on some of the small cap themes, right? Whether it's the AI data center themes, etc., etc., etc. So that's it for me today, guys. Hopefully you guys enjoyed. If you did, consider dropping a like. Would really enjoy it for the growth of the channel. Consider subscribing to the channel if you're new as well. We do these every Monday to Friday after the close, unless I'm not here for various reasons on Friday. And overall, guys, if you have any questions, please feel free to leave them down below in the comment section. I would love to answer you guys too. And last but not least, if you guys were tired of trading and investing in the markets all by yourself and you wanted to do so with me as part of a group of over 300 different members, you may consider joining our trading and investing group. The link to join us is down below in the video description. Now, what you get in that group is a few different things. Number one, you get all of my trades and my ideas in real time, whether those are the small cap shares that we've talked about today's video, whether they're the wheel trades or the leap call option trades or some of the directional trades, short-term directional trades that I make with debit spreads or other things of that nature. You guys get access to all of the trades in real time and any longer-term investments that I'm making as well. You also get access to our private morning live streams Monday to Friday, where I trade the markets live every day for about 2 hours, 2 hours and a half. And I also answer all your guys' questions on your stocks, your options, your trade ideas, your long-term positions. That's the best place to ask me all the questions that you guys regularly ask me in the comments section. It's a lot easier to answer those questions when I can show you the options chains, show you the charts, show you the fundamentals, and explain why I'm deriving the conclusions for those answers that you guys ask me, right? The questions you guys ask me in the comment sections. That being said, you also get access to our chat rooms, of course, where you can ask me your questions throughout the day. If you can't be there in the live streams, I'm very fast to answer all throughout the day. You get access to our private video educational section. That's about 15 hours of content, fundamental analysis, technical analysis, how to build a trading account, how to build a long-term portfolio, how do I do my leap call options or my other swing trades, right? All of the trading strategies and all the educational content that you guys ask me about, it's in that section. I will never put it on YouTube. It's exclusive for our Discord members. And last but not least, you do get access to all of my watch lists and all of my charts. Whenever you see support resistance boxes on the charts like this, whenever you guys see fundamental breakdowns such as these on over 100 different companies plus, right? Well, you can just copy paste all of my charts, all of my analysis, it becomes yours, and all my watch lists that I use to trade the markets on a daily basis. 15, 20 seconds, few clicks of a button, you copy paste all this stuff and it all becomes yours. Those are most of the benefits that you get as a Discord member. And you also get to have a lot of fun with us in the markets every single day. So if that's something that you might enjoy, you may consider joining us with the link down below in the video description. And if not, I guess I'll see you guys right back here on the channel. That's it for me. Take care. Have a good Friday session and have a beautiful upcoming weekend. I'll see you guys on Sunday. Take care and peace.